If you're like many other Americans, you probably OD'd on bonds during the Great Recession and kept buying even as stocks bounced back in the recovery. But now, bond yields are shooting up. Billions were withdrawn from Bill Gross's big bond fund, and some pundits say the 3 decades-long bond rally is over. So how does a fixed income junkie detox? We talked to Tom Karsten, president of Karsten Advisors, where he manages more than $300 million. He doesn't advise you to dump bond funds, but rather reallocate some of your bond holdings.
So many people are used to hedging their equity investments, but there's really been no need for that, of course, in bonds with a long-lasting bull run there. Now, with what we think will be more continued and steadily increasing interest rates, there may be a need there so that they could potentially hold on to their bond positions, mitigate the risk associated with rising interest rates, but continue to collect the coupon or income from those investments.
Here are 3 ways. 1, bet against treasuries. He likes the triple T. That's the ticker for ProShares Ultra Pro Short 20-plus year Treasury ETF. It shorts long-term treasuries by using derivatives and swaps. As bond yields began spiking in early May, the ETF took off like a rocket, rising more than 43% since then.
It is a leveraged ETF, so you're getting, in essence, more hedging for a smaller investment. So for our investors, we were able to take a 3% position, and it effectively allowed us to hedge what we currently have is about a 15% allocation to fixed income in the portfolios.
2, shorten the duration of your bonds. He recommends the Schwab Short-Term Treasury ETF, which tries to track the Barclays U.S. 1 to 3 year Treasury Bond Index. It's dirt cheap, but as with short-term bonds, the yields are very low. It's flat this year, but outperforming the intermediate Vanguard Total Bond ETF's loss of 2.5%. 3, stable value funds. These alternatives to bonds are offered in retirement plans. They pay a set interest rate and outperform money market funds. They typically hold short to intermediate term bonds that are protected from swings in interest rates by contracts from banks and insurers. They're currently paying nearly 2%, puny compared to stock returns, but gigantic compared to the 0.7% yield on 1-year CDs and stingy 0.1% on money market accounts. In the bond portion of Karsten's clients' portfolios, he allocated 20% each to the ProShares and Schwab ETFs. And in retirement accounts, he recommends converting all of your bond holdings into stable value funds. So remember the 3 S. You can short bonds, go short term, or go stable. That could hedge against any carnage you might suffer, and you might actually make money in the process.